Welcome to the monthly briefing number 2. It's for people who don't have much time to look at what's happening in the economy and the stock market. I'll cover what has been happening for the past month since my last report. I'll focus more on the things that happened in the past week because I haven't done an update on this. We'll cover the US economy, the banking crisis, the AI bubble, the stock market, and what it means for your portfolio. So let's get started, and everything will be in the blog with a link in the description if you want to check it out for yourself. The economy, in the past few weeks, the hard data has continued to worsen, and the soft data as well. And here was just the retail sales to show you how it's been mostly flat. So basically the soft landing narrative that the Fed has been pushing, the government has been pushing a bit, and media has been pushing, it's not going to happen. Looking back also, the GDP cancellation, now I think we know why, because with the data published this morning, the job market and retail sales, it looks really bad. So the GDP data will probably be really bad. It will be published in January with the final number. So we'll see what happens. In terms of the new development, the K-shaped economy is really getting worse. Like it's diverging more and more. And right now, it's not only affecting small business anymore. It's really affecting large companies as well. They have trouble paying back the debt. And so that's really something, because the number is the highest since 2010. So think about the 2009 financial crisis, and we're reaching levels that were less since after the recession already started, so for 2 years. I was talking about the wealth gap. Here's a chart from Dalio. You can click here and get to the article. But basically saying that when you get such a divergence, usually you get internal and external conflict. And the last time it was this high was just before World War II. And this is just the index of consumer sentiment showing you that the data going back to 1960, it's the lowest ever. I just put a quick thing here about the GDP. Sometimes there's a mirage. Here's a quick example for Canada. It would apply to any country, but basically for Q3, they published a GDP that was positive, but it was only positive because of accounting the imports going down, which is a really bad sign, not a good sign. And so without the imports going down, it would have been negative and it would have been a technical recession. Let's get to the Fed. So just looking back at the 3 weeks leading to the Fed, so they were basically saying that it was fine and maybe there would be a need for a cut. And for a while, that was the market consensus, but then they completely changed. And something else that was happening in the background was the banking crisis. So we saw the Repo chart is showing when people go to the Fed, like banks, to borrow because they are the lender of last resort and only resort. And it means every single time that no single bank was willing to lend to another bank at any rate. So that's really bad. And this is a graphic from this morning, so December 16, just to show you that despite the Fed ending QT, so money destruction on the December 1st, and starting to print with QE or QE Lite since then, there have still been 2 instances where banks were forced to go to the Fed. And even yesterday, they went to the Fed despite everything that's been happening. So it really shows you that even though they say we have the tools and everything is under control, clearly it's not. In terms of the new thing that happened in the past week, the money printer restarted and there have been several announcements. So first, during the press conference, people were expecting a cut, but they were expecting a hawkish cut, meaning the Fed would actually say, we are done, for now, there's no for guidance for it. That's just a risk management thing. But they actually said a few things that surprised the market. First one was that they announced that they would start printing 40 billions per month with no end date in sight. And that's in addition to the 20 billion they had announced at the previous one. So that's a total of 60 billion per month of added liquidity to the market. So you can see how quickly they switch from destructing money to printing money again. And I know it's not technically QE, but you don't need to focus on the definition. The thing is, it's liquidity injection in the system. It always starts with light QE like this, but eventually they have to do real QE in buy bonds, and this goes into the real economy. And the other thing is that this is the balance sheet, I'm sure you saw it before, of the Fed. And every time they have to go up, they try to go down, but they can never go back down to the level it was before. And so that's why the plateau is always going up. Ben Bernanke famously said that they would normalize the balance sheet, meaning they would go down to the level they initially started at. And you can see here we are more than 50% higher than when they started 2020, the last round of QE, and they are about to go up very quickly again. So it's just something they can never do, basically. The other important thing from that press conference was Powell admitted that the BLS data since April is probably overstating the average number of jobs created per month by 60,000. And since the average right now is about 40,000 per month, that turned into a negative 20,000 per month, at least since April. And, it could be much worse. This is just the Fed saying what they think it is, but they are always optimistic. So you have to take this with a grain of salt. And the other thing that's interesting is they've been always saying that they are data dependent, meaning they don't make a decision unless they have hard data to back it up, because they don't want to rely on anything else. Yet here they are taking again a decision to cut and a decision to print money, but they say that they don't have any data, and the data that will be coming in the next few weeks will likely be unreliable because of the government shutdown. So you can see how they keep changing the narrative and the justification to suit whatever message they want to push, but really they are flying blind and they have no clue what they're doing and they are always late. And so it's going to be really bad, I think. And that's why they will likely be forced to do an emergency cut by the end of January, because eventually they won't be able to avoid acknowledging the situation for what it is. Now let's go to the banking crisis, which are related. So first, I wanted to a brief look back. In the past few weeks, I'm not sure exactly the date, but basically we had two high-grade UBS private credit funds that blowed up. And this was something that reminded me of what happened in 2007 with Bear Stearns. So in June 2007, they had also two high-grade private credit funds that collapsed. And it was the canary in the coal mine for what ended up being the 2008 global financial crisis. Remember, those high-grade funds are supposed to be really safe. And so when people rush for the exit and ask to withdraw their money all at once, that's not a good sign. And the important thing about the private credit is that it's really a massive and growing market, and it's related to AI. I'll talk about it next. But first, I wanted to talk to you about First Brand. It's a company that was bankrupt. It's not in AI, but it's really probably the canary in the coal mine for the credit market as well, because when they went bankrupt, they got a loan that's called a deep loan. And so that's a debtor in possession. Basically, it's one of the safest loans you can get. You can give as a lender, because since 1988, based on my research, it only happened once that a lender didn't get 100% of their money back. All the other, they always get their money back because they get in front of the line. So whatever the company going bankrupt does in the end, they have to pay this loan first. This loan, on the first day where the Fed is already starting to print money, lost 60% of its value overnight. So that shows you how, if the safest loan can lose money so quickly and the value collapse, what happens to the rest of the collateral in the private credit market. So that's really scary. Something else also that is showing you how it's kind of related to AI a bit is Oracle. Their credit default swaps, the interest rate for people who want to protect against a default of Oracle, is exploding and reaching a level last seen during the financial crisis. And also, based on my research, it's at the level of Lehman Brothers in 2008. So, just to give you an idea of how the AI bubble and the private credit market are colliding. So briefly, for people who haven't been paying attention, for the past 4 weeks, the AI really narrative has completely changed in terms of what the market wants and perceive, especially when it comes to the stock market. And so it used to be that they could announce AI capex and everything was fine. The stock market would reward them. Now it completely shifted. Now people are like, does this make sense? Can you make money from this? They're looking for a return on investment, not just a blank check, basically. And so this is going to be interesting, because the recent announcements from Oracle and Broadcom are a perfect example of this. When Oracle published their earnings, so it was after the Fed, their stock tumbled despite announcing capex like in the past. And others were also affected when Oracle, tumbled. Basically, people were like, oh, you are taking on more debt, yet your biggest client, OpenAI, has to be profitable within 2-3 years to pay you back, so you can profit from this. And so you probably will be holding the bag at the end. And, even in the best case scenario, OpenAI is not projected to be profitable before 2032 or something like this. So this is something that was kind of scaring investor. Something else, Broadcom, they published earnings, they beat. If you look on the surface, it looks great, but people actually look, and it's not because of AI, it's not because of sales, it's not because of good things. It's just because of accounting things they changed. And so again, when you look beneath the surface, because the euphoria around AI is starting to fade, especially for people looking deeper, not people just buying without thinking, it's really changing things around. Two other things I wanted to mention. First, Microsoft. It was leaked that they are canceling the sales quotas for anything related to AI. So of course, their stock was penalized when this was announced. And it shows you how people are not interested in buying the solution from Microsoft, especially businesses. And so this is really affecting them. And so instead of just missing their sales quota for AI, they just canceled it. And I kept the best for last for the AI. For a few years, the US has been banning Nvidia and other big players to sell GPUs to China. Of course, China has been able to get some by going around. But finally, the US government says, okay, we will allow you to sell the GPUs to China, but we'll get a tariff on it. And China basically says, no, thank you, within 48 hours. That shows you how China is not willing to depend on the US and want to develop their own architecture, which is a big bifurcation for the way they develop AI. Now let's look at the stock market and the impact of all this. So first, if you look back on October 29th, I told you that it was going to be either the top or the start of the topping process. So it looks like a topping process, a bit messy like the end of 2024 and early 2025. The one thing that's interesting to see is that there is really a rotation from smart money to dumb money, retail investors. And you can see on this chart the confidence. So it's near all-time highs for dumb money, retail investors, and it's quite low for the smart money, the institutionals. And so one of the reasons why you haven't seen a real crash yet is because they are not selling everything, they are rotating. So from tech and AI to value and safe haven. And so that's kind of why the stock market has been in that pattern like the end of last year. But basically, once they are done with this and they might start to want to raise cash, it might trigger the real crash. Something that's also interesting if you're investing in the stock market is that recently the risk premium has turned negative. So it means that it's riskier to invest in the stock market than to just take a T-bill or something where you are guaranteed your capital and interest on it. And so that's really bad because usually when you get this, people pull back money from the stock market and then it's a vicious circle. The VIX signal also the fear index, and right now it's extremely low. It signals complacency, and this usually happens before big moves. You can see every time there was a spike, just before the spike, it was a low. In the past 4 years, especially, every time the current configuration happened, there was at least 10% pullback or correction on the S&P. So you can do whatever you want with this information, but it's just to give you an idea of there are so many indicators pointing in the same direction. And I thought that this picture illustrated well the opportunity. Right now, investors are so complacent that portfolio insurance is really cheap. And so if you're interested in this and know how to do it, it's a good time. It's not financial advice, but just I'm sharing with you what I'm seeing and doing. And so if you want to actually do it, here are a few ways you could. So if you haven't already watched, I have a free masterclass where I share 5 strategies, including this one. If you see it and you're interested, but you don't know how to do it and you're not sure if it's too complicated, I even recorded a demo where I shared my screen to show you how easy it is to buy and sell those products. So you can click here if you want to see the demo. And if you want my help, there are 2 ways to do it. So right now there's a self-paced course you could take on put options. It's really complete. It should give you everything you need so you can do it on your own if you feel confident. And if you are not confident doing it on your own, you could apply for one of my remaining spots for the one-on-one coaching as well. So now, briefly, I wanted to mention some things about precious metals and crypto because I keep getting questions. So basically, since the last month, there hasn't been many change. I mean, gold and silver continue the uptrend that I talked about, and Bitcoin has been in that rebound that I talked about, but likely will start the downtrend to finish the move soon. The one thing I wanted to mention, though, about silver, because I thought it was interesting in the past month, in the night of November 13th to 14th, there was a trading halt for about 10 to 12 hours, officially because the servers needed cooling. In practice, this is the kind of thing that happened when the dealers are in panic mode and try to, stop the bleeding, basically, of a short squeeze on silver, just like in the 80s. And so I have people who are really knowledgeable in that area who've been sharing info with me about this. But yeah, basically, something shady is happening in the silver market, and we could potentially be seeing a short squeeze by the end of January. So something to keep watching. Same thing for gold in a way, because once, one of them takes off, usually it attracts people. And the other thing I discovered in the past week, or I learned, was that silver is a Giffen good. It means that actually when the price increases, the demand increases because some companies, they don't have a choice. If they don't buy silver, if they don't have enough silver for production, like for electronics, think Apple, Tesla, and all those companies, well, they would stop production, they would stop revenue, it would be like the end of the world for those companies. And so the more the price goes up, the more they need to reserve stock. And sometimes they even go to the miners themselves to try to reserve some stocks. And of course, it's pushing the price of silver up. So something to keep in mind because it could really be the perfect storm for that silver squeeze. Now let's look briefly at what's going to happen over the next 6 to 8 weeks because there's going to be a lot of things. For December, the data avalanche of the post-government shutdown already started this week, especially this morning with the non-farm payroll. I won't talk about it in this video because I'll talk in the next one, but basically it was really bad and there will be more data coming on. This week will be particularly important for Friday because it's a triple expiration. You have an expiration for options and futures for the weekly, monthly, and quarterly. And so that can add a lot of volatility just on a normal day. But on that day, there's the Bank of Japan wildcard. They could be hiking again. That's what is the base case right now. And if they do, that could really exacerbate the whole thing because it would pull out liquidity from global markets. And so then it's a vicious circle. So we'll see how it goes. But I think a lot of people are going to sell ahead of it. And so the sell-off could actually start on Thursday. Lastly, the volume is likely going to be low, which can affect volatility, of course, because it doesn't take as much money to move the price. And the Santa Claus rally, I think, is going to be canceled just because the market is running on fumes and there was no pause between April and now, basically. So I don't think there's enough juice in there and good news to keep it up. But we'll see. It's still possible. January is going to be the make or break, basically, for the market. First, there will be the Supreme Court decision regarding the tariffs for the US. And so regardless of what happens, I think there's going to be a lot of volatility because it will create uncertainty. Because if the tariffs are approved, maybe, they can be increased, or, some companies were hoping for the tariffs to be reversed and to be reimbursed. It's going to be really bad and their earnings will show. And if it's rejected by the Supreme Court, I'm sure the government will try to find another way to get the tariffs going again. And so one way or the other, I think it's going to be a big catalyst pushing the market down and the global uncertainty down or up. It's going to be a lot of more data that the Fed will be looking at and other central banks as well. And there will be a decision by the Bank of Japan and the Fed and the Bank of Canada. So it's going to be a busy month in terms of key data that, again, has all the potential to trigger a severe crash or just, regular correction, but a reset is needed either way. Lastly, I wanted to finish this video by telling you that the most important thing in this kind of environment, based on my experience, is not to try to get the last squeeze of the lemon, a little bit more profit before cashing out for the year. It's really about protecting the capital so you don't have to try to get your money back if you lose a lot of money. If you found this video, this blog, or these resources useful, feel free to share it with someone you know could benefit from it. If you have any questions related to this video or the blog post, please put it under the video. I'll do my best to answer it. And I hope you found this useful, and I'll see you on the next one.